Let's get in our fundamental voice. Nick Paulson, of the country head of strategy and special situations at Espirito Santo Securities, joins us right now in our studios to talk about his sense of what the markets are likely to do in the near term. Nick, good having you. Thanks so much for taking the time out. Your base case scenario is slightly different from what a lot of other people believe the RBI could do, and that is tinkering with the rates. You believe the kind of cuts, the repo rate cuts, 25 to 50 bips or 50 bips might come in the current policy itself, or will it be a staggered movement over the next 2 or 3 policy sessions?
Yeah, I think it's a difficult call right now for the RBI. I think from our perspective, if you look at consensus, it's looking at nothing on the repo, but a 25 basis point move on the CRR. I think our view is that given what's happened over the last 6 weeks in terms of policy action from the government, there's been an imbalance in economic policy between fiscal policy and monetary policy, but the government has pushed through so many initiatives, particularly on the fiscal side. We think the RBI is likely to reciprocate. And if you look at inflation, we were expecting a lower number in September and ended up at 7.81, which doesn't help. But I think food inflation pressures are lower than people feared because of the monsoon reviving in the later stages. So I think on balance we think it'll be some sort of move on the repo rate. Also, the RBI has tended to prefer surprising the market, which I think is another factor. But I think there's been a lot of pressure from the government, and I think there'll be some kind of reciprocal move responding to what the government's done.
Nick, so what is your sense? We've got the cabinet rejig as well slated over the weekend. Do you think this could be a market-moving event, or it doesn't really make a difference?
I think in terms of cabinet, I doubt it. I think for the next few weeks we're looking at the main moves are going to be the earnings season and on the 30th what the RBI does. And I think that's where all eyes are focused.
Okay, how have you mapped the earnings so far? Because a lot of people have said that there has been a bit of a positive surprise. Aside of a couple of disappointments, maybe in large cap IT or otherwise, banking has been particularly good. A couple of other spaces like capital goods, the commentary has been positive. How have you mapped earnings till now?
Yeah, I think if you look at global earnings and then you look at India earnings, it's balanced. I think India's slightly better than so far. We're still at relatively early days, but slightly better than anticipated. And I think if you look at the last 3 quarters, you've had this. India's been in an earnings downgrade cycle. If you look at the BSE 100, it was down. If you look at the last 3 quarters, the downgrades have been 3%, then 2.5%, then 1.8%. We're probably now at the bottom, and so far looking slightly better than expected. Globally, Asia's been slightly weaker than expected, US slightly weaker, Europe has been slightly better than anticipated. And I think in terms of specifics, I think something like L&T, very good order inflow growth, surprised people, surprised us, did better than we expected. But it's already run up 60%, that's one of the problems. But I think still held by a lot of people because people are playing it for the capex cycle. Banks, it's been mixed. I think private sector banks have been pretty good, but some pressure. So IndusInd, there was a little bit of pressure in terms of asset quality in terms of commercial vehicles, and then the PSUs, it's been mixed. So Bank of Baroda was slightly weaker, OBC was slightly better than expected. So still a mixed picture, but I think it's bottomed, and it looks like the results can be slightly better than anticipated.
So just want to get back to L&T and your short-term as well as long-term view on that. Is it time to profit book for the near-term investors? And on the long-term basis, would L&T still be a buy after the run-up that the stock has already seen?
Yeah, I think we had a buy and we were pushing it aggressively earlier in the year within the overall theme of pushing capital goods. But after it ran up 60%, we downgraded it to neutral. I think my own view, though, is that most investors will hold on, and because if you look at power and infrastructure generally and capital goods, there's a quality problem. There aren't many stocks that people are comfortable holding. If you look at the experience of the last 2 years, it's been very difficult, and so I think people will hold on to it, and because it's the best quality play on the turn in the capex cycle, and there's so much effort going on by the PMO to drive project clearances and the cycle. I think there is still potential for L&T to surprise in the second half in terms of order inflows.
Since you're on the topic, but very quickly, you seem to be bullish on some of the other tier 2 power players as well. And is it because of the airport play that you like GVK and GMR, or are there other reasons?
Yeah, I think GMR, GVK, partly is valuation, misunderstood stocks, often disliked stocks, and I think because of the extent of the rally, the recent rally, the market did, 9% in September. If you want to play power and infrastructure, you have to go down a notch if you want to add beta, going down a notch in terms of quality. GMR, GBK come with their issues, but I think those issues are beginning to be resolved. They're not well understood, and we think they're mispriced as stock. So valuation plays, but they come with their issues.
What about IT, which was the first of the lot, and how would you place your pecking order when it comes to the frontline as well as mid-cap IT names?
Yeah, on frontline IT, I think our preference is, if you look at TCS, it's clearly done very, very well consistently, whereas Infosys has been in its, 6 quarters now where it's been disappointing the market. But we still think in terms of the strategy is right in terms of the flexibility, the level in terms of pricing, the drive towards volume growth, and just being more aggressive. And we think that is going to gradually start paying off. So if you look at the valuation differential between Infosys and TCS, we think it's unjustified, and we prefer Infosys at the moment versus TCS. And that preference still holds. We've had that for just over a quarter now. In terms of the mid-cap IT names, we quite like the mid-cap IT names. It's either looking for companies that have got strong niches, and of those, persistent systems and KPIT are names that we like, but generally constructive on the mid-caps IT sector.
I think I want to scratch that further. Persistent systems, I'm hearing a lot of good things. They came out with a fantastic set of numbers, talk about the IP revenues going up from the current 20-25% to 50%, and a lot of people talking about it being a portfolio stock. Are you in that same way? Yeah, and I think it's not. I think the IP revenues, the margin improvement you get when that comes through, it's got a strong niche position. It's not well known, so we did a roadshow for them in Asia earlier this year, and a lot of investors were impressed, hadn't met them before. So I think it's one to put on the radar and monitor. So I think it's a good and interesting niche business. Interesting. Okay, that aside, Nick, just wondering, what's the call really on some of the auto names? There have been divergent trends emerging. Almost everybody saying that the two-wheelers are in a slightly long-term or a medium-term down cycle of sorts by virtue of competition coming in from Honda, particularly Hero MotoCorp. What's your sense? Yeah, on autos, because we're literally just in the process of initiating on the auto status, so I'd rather not, otherwise I'll be talking in advance of my analysts, so I'll leave that if you don't mind.
What about some of the consumption names, and more so from the FMCG space? We've seen what ITC delivered, not a pure FMCG company, but that, on the other hand, names like a Dabur, Marico, or for that matter Tata Global Beverages, which has seen a fair amount of rally this year.
Yeah, I think ITC surprised us because, as you probably know, we had a negative on ITC, which our thesis was that the volume growth was going to disappoint in the face of all the price rises, but actually did very well. If you think about the price rises ITC's pushed through, to deliver flat volume growth is very impressive, and we've changed our stance on ITC, and we're now neutral on it. It's rallied 40-odd% since we had a negative on it. But I think ITC is an unusual one. It's a different context when the rest of the consumer group. So far, I think, you look at HUL today, the market's looking for 8% volume growth, and it's probably going to deliver that, but it's expensive. It's still 37 times one-year forward earnings. For us, we're still underweight the overall consumer sector, and you saw at the beginning of earnings season, TTK Prestige disappointed, and that category of consumption, consumer durables, has seen a little bit of pressure. And so far, there's not that much sign of it feeding into FMCG, which are smaller, lower price points, and they're not as discretionary as purchases. But I think there is going to be some pressure. I think, given their price to perfection, the likelihood of some pressure in terms of just general pressure in the face of, if you look at the pressure consumers have been under in terms of real wage inflation, and just this persistent inflationary environment we've been in for 2 years, you're likely to see some kind of weakness coming through this quarter, next quarter. So we're underweight the overall consumer sector.
And would that include Tata Global as well?
That we don't cover Tata Global Beverages. But I think in general terms, I think the kind of core consumer names, which are almost over-owned, the HULs, the ITCs, they're the favourites of most foreign investors, whereas the likes of Tata Global Beverages, some of the smaller auto names, they're not necessarily as well held, and hence they're not priced at the sort of 30+ times earnings.
Okay, I was just looking at some of the key stocks that you are bullish on, and correct me if I'm wrong, but I saw one bank and not too many others, Federal Bank, in which you're bullish. Is that the top pick from the banking space, or is there something else that you like?
Yeah, so right now in the PSUs we like SBI, but I think our top pick in terms of the banks is Federal Bank. I think it's less well held. If you think about the large private sector banks, particularly Kotak, Indusint, HDFC are very well held, good businesses doing very well, performing well in the face of a difficult environment in terms of maintaining asset quality, but they are maintaining it. I think if you look at Federal Bank, you've got a number of trends in their favour. You've got a business which is, firstly, it's cheap. It's trading at just over, if you look at FY14 book, just over 1 times book. So big contrast to the rest of the private sector banks. It's already now got 45% of its loan book outside of Kerala, so it's been developing. It's the 4th largest bank in terms of point of sale, ATMs, branch network. It's going to show substantial ROE improvement from sort of 14.5% to 17% going into FY14. And so you're seeing that combination of good valuation, ROE improvement. Sometimes people worry about asset quality, but the volatility being more of the way that accounts for its asset quality and slippages on a quarterly basis. Actually, we think there's going to be an improvement. So Federal Bank is our top pick across the banking sector at the moment.
What about Reliance Capital? That's a surprise addition.
Well, it's done very well this year. So last year, Reliance suffered. This year, it's done well. I think if you look at, most people would recognise us with the insurance sector. We like the insurance sector. If you think about Nippon Life's investment in Reliance Capital, they came in at 2.6 billion. Their valuation of Reliance Life was the same as the valuation of Reliance Capital as a whole entity at the time. So overall, we believe that IRDA as a regulator, it's a much more constructive relationship with the industry, and you're beginning to see, after 2 difficult years in the insurance sector, volumes are picking up, and you're going to see that, and Reliance's numbers are improving. So the main driver of our bullish thesis is Max India has been our top pick in insurance, but it's run up. Reliance Capital is more expensive, predominantly based around the insurance business, but the other businesses are doing better as well.
Okay, Nick, just a final couple of questions really. You guys in the past have come out with reports and covered stocks wherein you've given a strong sell signal and a number of cases. Anything that you believe is a complete avoid, never mind the fact that the market may be in a bit of an uptrend?
I think in terms of the ones we'd probably avoid at the moment were people are just playing the investment cycle to go into capital goods, and when they look at L&T gets expensive, has a good rally, people move down the curve in terms of quality and looking at something like BHEL, where that for example, we have a sell on BHEL. We think there's just a structural issue in terms of Chinese competition, and we wouldn't, even though people want to play the asset